The stock market should have crashed by now. And not just a gentle pullback. I'm talking about a full-blown, unmistakable, market-wide correction. Every major indicator is blinking bright red like a dashboard screaming, "Engine failure." Consumers are buried under debt. Savings are evaporating. Inflation is eating paychecks alive. Corporate earnings are thinning out. And the economy underneath the surface is quietly cracking. Yet, somehow, the market just keeps climbing. It defies gravity. It defies logic. And honestly, it defies basic financial math. But once you understand the real forces holding this market up, forces almost nobody talks about, suddenly everything that feels confusing becomes painfully clear. And you'll finally understand why the crash hasn't happened yet, and why the delay is the single most dangerous part. I'm Seth. I've spent decades in banking, fintech, and financial systems. I've sat in rooms where billion-dollar credit lines were approved, watched traders take positions the size of small countries, and I've built financial models for big institutions that would terrify the average person if they understood what was inside them. And even with a finance degree and an MBA, I've looked at this market the same way many of you have and thought, none of this makes sense. News headlines warn of recession. Economic data looks weak. But the market floats upward like it's on autopilot. For years, I thought I was missing something obvious. Then I realized, markets don't fall when things look bad. Markets fall when the forces that keep them artificially held together finally snap. Right now, those forces are stretched so tight that a small spark could shatter everything. And if you think I'm exaggerating, consider this. Warren Buffett, the most disciplined investor alive, is sitting on a historic mountain of cash. And one of the biggest reasons is a ratio very few everyday investors pay attention to. The market cap to GDP ratio. People call it the Buffett indicator. All publicly traded U.S. companies combined are worth around $66 trillion. Meanwhile, U.S. GDP is about $30 trillion. That means the market is trading at nearly 220% of the nation's economic output. To put that in perspective, before the dot-com bubble exploded in 2000, the ratio was just 115%, not 150, not 180, just 115%. And back then, the market dropped over 60%. Today, we're almost double that danger zone. If history rhymed any harder, it would be shouting. But valuations don't stop there. Price-to-earnings ratios, the simplest measure of how expensive stocks are, have gone from normal to absurd. Historically, the S&P 500 trades at around 15 to 16 times earnings. Today, we're sitting between 25 and 28. That alone indicates danger. But the real insanity comes from the mega-cap giants carrying the entire market on their backs. Nvidia sits at a PE above 50, Amazon and Microsoft hover around 35 or more. And Tesla? Try over 250. Think about that. Investors are paying over $250 for every $1 of earnings. That's not optimism, that's delusion. And here's the eerie part. Before the dot-com crash, the average PE was roughly what it is today. So no, the numbers don't justify this rally. The fundamentals don't justify these valuations. The economic backdrop definitely doesn't justify this confidence. So why hasn't the crash already happened? The answer is uncomfortable. The economy is being artificially propped up by forces that the average person never sees. They don't show up in headlines, they don't appear in political speeches, and they're not taught in personal finance textbooks. But these forces are powerful and temporary. And when they fade, the market will snap back to reality fast. The first force is the government quietly stimulating the economy without calling it stimulus. People think stimulus ended years ago because the checks stopped. But the hidden stimulus never stopped. The U.S. government brings in around $5 trillion a year in taxes and spends about $7 trillion. That $2 trillion difference. Borrowed money that flows into the economy like steroids pumped into a tired athlete. It props up businesses, it props up jobs, it props up consumer spending, and eventually, it props up the stock market. When trillions flow into the system every year, it doesn't matter if the underlying economy is weak. It creates the illusion of strength. But the US now has over $38 trillion in national debt. And interest alone costs more than $1 trillion a year. You don't need a finance degree to know that no government on earth can run that math forever. The second hidden force is inflation and a weakening dollar. The quiet villains nobody wants to talk about. A weaker dollar makes US exports cheaper. Investors abroad buy more assets, and companies raise prices faster than ever before. Inflation isn't just a silent tax on the public. It's a gift to corporations. When the dollar loses buying power, a company can raise prices, report higher earnings, and claim growth even if fewer customers are walking through the door. That means many record profits aren't actually growth. They're inflation wearing a mask. Wall Street knows this, and big investors love it. Because when inflation rises, two things happen. Asset prices climb, and debt becomes easier to pay back. If you borrow $10 million today and inflation goes high, you pay it back with dollars that are worth less. Inflation punishes ordinary people, but rewards leveraged investors. And the top 10%, who own nearly 90% of all stocks, know exactly how to play this game. And this is the real reason the market hasn't crashed yet. The rich are borrowing cheap money, buying assets, and riding the inflation wave. Meanwhile, everyday consumers are drowning. Credit card debt is at all-time highs. Savings rates are near rock bottom. Buy now, pay later. Usage has exploded. People aren't spending because they're confident. They're spending because they're desperate to maintain a lifestyle their income no longer supports. The labor market is the next illusion. For a while, jobs data looks strong, but now, hiring is slowing, layoffs are rising, and job openings are shrinking. This is exactly how every downturn begins. Slowly, quietly, and then all at once. A weak labor market means weaker spending, and when consumer spending drops, the US economy drops with it. Some people think interest rate cuts will save everything. They won't. Rate cuts don't magically erase record-high consumer debt, shrinking savings, or companies squeezed by higher costs. Rate cuts don't revive real purchasing power. Rate cuts don't fix structural weaknesses. Rate cuts are a painkiller, not a cure. And this brings us to the most dangerous stage of all, the psychological pattern that repeats before every major crash. Markets don't collapse when things look bad. They collapse when investors get used to bad news. When people say, inflation again? Whatever. When layoffs barely move the market. When earnings warnings get shrugged off. When fear disappears. That numbness is the calm before the storm. It's the moment in every cycle when investors start believing the market is invincible. And that's exactly where we are today. The final trigger that causes a crash is never obvious. Sometimes it's a major company missing earnings. Sometimes it's a credit event. Sometimes it's a bank revealing liquidity problems. It doesn't have to be dramatic. It just has to break confidence, because confidence is the only thing holding this market up. And confidence is a fragile thing. The University of Michigan Consumer Sentiment Index recently hit one of its lowest points in modern history. People are anxious. People feel the disconnect between what the market is saying and what their wallet is saying. And when people stop believing the story collapses. The most misunderstood thing about this entire situation is that the crash hasn't been avoided. It's been delayed. And delays make crashes worse. When a market climbs on real growth, corrections are healthy. When a market climbs on artificial support, inflated valuations, weakening fundamentals, and consumer debt, the correction becomes a reckoning. And when it hits, it doesn't drift down slowly. It snaps, hard, fast, and violently. That's why understanding this moment is critical. Not to panic, not to predict doom, but to stay rational when everyone else loses their mind, to avoid getting trapped in the false sense of security that always comes before a collapse, to recognize that markets are emotional machines, and when the emotion changes, everything changes instantly. And here's the truth. Nobody in government, big banks or Wall Street wants you to fully grasp. The system benefits from your confusion. When the average person doesn't understand what's happening, they stay in the market longer than they should. They keep spending when they shouldn't. They take on debt they can't handle, and they buy into the illusion that this time is different. But it's not different. The market is not rising because of strength. It's rising because of temporary forces that are already weakening. The crash isn't canceled, it's queued. And when its turn comes, it'll arrive faster than most people expect. If this breakdown helped you see the big picture clearly, hit like, subscribe for more no-nonsense financial insight, and check out the Financial Fundamentals bundle link below, especially if you're serious about protecting your money, building real wealth, and staying ahead of the chaos. The world might be confusing right now, but clarity is power. And I'll help you get there.